Greetings, members one and all of the Salivation Nation. Does JP Morgan really play that big of a role in silver price manipulation? Let's explore. Yes, this is an article from Seeking Alpha. It's quite interesting because it addresses this, among other things, and it's sort of a bullish outlook for silver. Let's kind of take a look at this from this perspective from Seeking Alpha, Andrew Haidt. Last year, the U.S. Department of Justice indicted a handful of former JP Morgan traders on spoofing and conspiracy charges. Investigators charged individuals with manipulating the silver and gold markets on thousands of occasions. It's quite a huge number. It's pretty amazing. This has been going on for quite a while. It says the wheels of justice do grind slowly, but there should be an additional developments over the coming weeks and months. We're tracking them here. In fact, we posted a video recently that it has moved into a criminal probe. A group of market participants continues to believe that JP Morgan is at the center of a massive market manipulation scheme dating back to its takeover of Bear Stearns during the 2008 global financial crisis. Some believe that the world's largest private U.S. banking institution continues to control the silver market and the price of the precious metal. Silver has been going nowhere fast, for sure, even though the next leg of the long-term bull market in gold got underway in June of 2019. Silver has yet to challenge its level of critical technical resistance at $21.09 per ounce, the July 2016 high. The silver is tightly coiled spring ready to snap to the upside. The Velocity shares 3x long-term ETN silver product USLV will magnify the price action in the silver futures market on the upside. Since January the 8th, the nearby COMEX March silver futures contract has traded at a range between $17.28 and $18.89 per ounce. However, if we exclude the high from January 8th and the low from July 29, the range has been tighter at $17.42 to $18.37 per ounce. At $17.75 on February the 14th, silver was trading closer to the bottom end of the trading range so far in 2020. As the daily chart highlights, price momentum and relative strength indicators were on either side of the neutral readings on the 14th of February. Daily historical volatility at 16.1% has declined from 27.25% on February the 1st as daily trading ranges in the silver market narrowed. The total number of open, long, and short positions in the silver market declined from 238,085 contracts on January the 27th to 225,675 contracts on February the 13th. That's a drop of 5.21%. Silver is trading in a range, and technical metrics are not providing many clues about the future path of least resistance for the price of the precious metal. However, I will say that even though silver is sort of languishing here, it wasn't that long ago that it was trading in the $15 range and low 16s. So it is seeing some movement upward. But gold has been outperforming silver for years. The price action in gold tells us that silver should be at a significantly higher level. Gold broke out above its technical resistance levels at $1,377.50 per ounce in June, but at $1,586 now per ounce on February the 14th on the April futures contract, the price is $208.50, or 15.1% higher than the previous resistance level that has become support. The technical level in gold dates back to the July 2016 high. At the same time, as noted earlier, silver was at a peak of $21.09 per ounce, while gold rose to its successive peaks of $1,559.80 in September 2019 and $13.30 in early January after the strikes from Iran. Silver never challenged the 2016 peak. In September, the high of the continuous silver futures contracts was $19.54, and in January, when gold made a higher high, silver made a lower peak at $18.89 per ounce. Silver has underperformed gold, but that is nothing new. The long-term modern-day average of the silver-gold ratio dating back to 1970s is around 55 ounces of silver for each ounce of gold valued at that level. The ratio has not traded to that level since 2013. And now look where it is. The monthly chart of the price of gold divided by the price of silver shows that at 89.07 ounces of silver required to purchase 1 ounce of gold on February the 11th. And you can see from that chart, look at that climb. That's a pretty big climb up there. Here we see there's 2011, and it's been kind of sporadic here, but it did get up there right at the beginning of 2016, and took a pretty big drop here when we saw that ratio tighten up there to just over 65 to 1. The monthly chart, so with that ratio just under 90 to 1, silver is historically inexpensive compared to gold, and the trend of the price relationship has been higher since it reached a bottom of 32.73 to 1. In 2011, around the time when gold peaked at $1,920.70, and silver reached $49.82 per ounce. And keep in mind, I think that part of the reason for this, and this has not been highlighted in the article, but you've heard me talk about it many times, is that silver, I believe, part of the reason for this languishing of silver prices is because it's being seen by the markets as more of a commodity than as being tied to gold as a hedge against inflation, or as historic money. But keep in mind, there is still some of that out there. But I believe these markets are reacting to silver as a commodity, like nickel, copper, lead, etc. I believe that's one reason. But JP Morgan is under the hot lights. Many market participants have blamed JP Morgan and other leading world precious metal dealers for the weakness in the silver market. For decades, the author have read about conspiracies that have created a big hand in selling above the silver market. After the arrest of traders and even some sales executives at JP Morgan, Deutsche Bank, and other financial institutions involved in gold and silver trading, the U.S. Department of Justice and CFTC are taking a long, hard look at JP Morgan. Investigators at the Department of Justice and CFTC have been examining the bank's trading activities over the past 2 years. And keep in mind, this has been happening for much longer than that. They have already charged traders from New York, London, Singapore desks with manipulation and conspiracy to commit fraud. These charges stem from activities that took place over a decade. While the spoofing and fraud charges are significant, RICO charges are far more severe, as they allow prosecutors to charge multiple criminal acts involving a group of people within the same institution. The current investigation may lead to more arrests and even charges against JP Morgan itself. Keep in mind, that's essentially RICO statutes racketeering. Those are charges that have been placed against the mob. A federal judge in Chicago recently ruled that both wire fraud and spoofing charges were appropriate in a case against 2 former Deutsche Bank trades, which will stand as a precedent for the case against the JP Morgan traders and perhaps the institution itself. We are likely to see more indictments as investigations climb the chain of command within the banks. More current and former senior traders may face charges, as well as higher-level executives at the bank. Keep in mind that some of these, actually heads of these, managers, head traders were charged as well. Some market participants are looking for an inquiry to go to the top, and JP Morgan CEO Jamie Dimon, Ted Butler, wrote the following in an article titled "The Genius of JP Morgan." Here's what he says. I suppose it would be convenient to point to the U.S. Justice Department's labeling of JPM's precious metal desk as a criminal enterprise in which RICO statutes have been invoked. But I've often referred to JP Morgan as a criminal in its precious metal dealings long before the DOJ came along. Besides the DOJ, up until now, seems to have specific focus on spoofing, something I consider peripheral to what JPM has done. My main justification for accusing JP Morgan of criminal behavior on gold and silver dealings is the fact that it accumulated its massive physical metal holdings while being the largest COMEX short seller in nearly 9 years. And I find a considerable fault in that statement, but here's what Andrew says about it. Mr. Butler goes on to say that he knows JP Morgan's actions were criminal and claims validation as he sent all of his allegations to the bank and regulators and has never heard any objection, threat, or denial. Butler also claims that the DOJ would never do anything to undermine the largest and most systematically important bank in the nation. Let's face it, JP Morgan holds all of the get-out-of-jail-free cards, and it needs to be left alone. Butler believes that JP Morgan, in the aftermath of its acquisition of Bear Stearns, has controlled the silver market and held massive risk positions in the precious metal. I agree that JP Morgan is the most influential bank in the gold and silver markets. However, his theory that the largest COMEX short seller accumulated massive physical metal holdings does not compute. Finally, somebody says it with some that challenges him on that, because I've been saying that as well for a long time. I question that. It's just there's no proof of that they're now they may be the largest custodian, but that doesn't mean that they own all those metals in the markets there. In the 1980s and 1990s, I ran one of the leading precious metal trading desks for a financial institution with offices in the US, Europe, and Asia. Financial institutions that trade precious metals hold gold and silver on either an allocated or unallocated basis for their customers. There you go, they're custodians, which include a myriad of market participants, including central banks and massive pools of capital. At the same time, the heart of the legitimate bullion banking business is borrowing and lending the metal via forward transactions. Producers sell for future delivery to hedge their output. Bullion bankers use fractional banking when it comes to their deposit base to fund those hedging transactions by selling on the COMEX or in the forward market. The bottom line is the more physical holdings, the more short selling occurs. Moreover, in the aftermath of the Dodd-Frank regulations, the capital charges on JP Morgan for holding the kind of long or short risk positions that Mr. Butler alleges would be enormous and way more than a footnote in the bank's earning disclosures. Therefore, the only way Ted Butler could be correct would be if the government that is prosecuting the misdeeds on the trading desk was at the same time conspiring with JP Morgan with exemptions from regulatory statutes. And that, my friends, is part of the far-reaching that some of these conspiracy theorists have, is they literally have to believe that there's some sort of collusion that would be almost impossible to cover up. Liken it to a 9/11 conspiracy theory, that type of thing. You have to dabble in those worlds in order for it to make this stuff believable. You have to believe there's some wide conspiracy. And most of those conspiracies, especially when you look at the ineptness of the government and the inability to keep secrets, a lot of this stuff does get out. If there was anything like that, there would be multiple whistleblowers if this was the case. The article goes on to say that prosecutors have a lousy track record, but they are going for a big fish on spoofing. The Department of Justice and CFTC are likely to continue to charge others in the widening spoofing and RICO investigations. The author believes would not be surprised to see the inquiry lead to arrest of more traders and even the person who ran the commodity trading business at JP Morgan for years. Some of the current traders facing charges and long prison terms under RICO charges are likely to sing like canaries and give the DOJ enough for other indictments. However, it is essential to remember that the prosecutors have had a poor conviction record since 2008 with these high-profile cases, and that is unfortunate. The jury acquitted the two hedge fund traders at Bear Stearns at the heart of the mortgage-backed securities disaster. Few, if any, mortgage bankers found themselves behind bars in the post-2008 headhunting by the DOJ and regulators. If the smoke leads to the C-suite at JP Morgan, the fines will no doubt be high, but the bank and Mr. Diamond will remain insulated. I may not agree with Ted Butler on much, but when it comes to the systematic risk of taking down the leading financial institution in the U.S., the DOJ will not go after J.P. Morgan for anything other than a fat fine for allowing manipulation by its employees, which means those fat fines are piddly. They're next to nothing to what they can afford to pay. The most serious charge will be turning a blind eye after the bank offers up some other sacrificial lambs to the government. And that is the unfortunate thing. And that, and people have been saying that when I've posted other videos about this topic, that what really needs to happen is these people need to get jail time. Well, they just get fines. Now, this is the other thing about that I will say about this particular aspect of it. What about gold? Gold is at getting very closer to all-time highs, and the precious metal spoofing and everything like that is happening with both metals. Why isn't gold seem to be affected by this, and only silver is being held down, but not gold? That's the question to answer here, and I think that will continue to be the thing. But what surprises me in this is that essentially the author is saying that spoofing will not go away. He agrees with Ted Butler that the price of silver will ultimately move appreciably higher. J.P. Morgan is not likely to make a killing or get slaughtered because of any risk positions at the bank are likely small and controlled. These prosecutions will go a long way to curb spoofing in the U.S. and Europe. But commodity markets are global. Spoofing by other market participants around the world will continue and could even expand. Those out of the reach of the prosecutors will use spoofing as a competitive edge. Chinese, Russians, and other traders around the world are likely to laugh all the way to the bank, as both have histories of market manipulators. Silver will go higher because the next leg in the bull market in gold got underway in June 2019, and silver will follow the yellow metal. And that's just it. That's where I break with the author here on this. It doesn't necessarily mean that it has to or that it will, because we've seen that it hasn't for so long. Just because gold goes higher doesn't necessarily mean that the ratio will squeeze. Yes, silver will go higher, but not necessarily doesn't necessarily mean that the ratio will squeeze or tighten. When silver finds a way to move past its July 2016 high of $21.09, the sentiment will shift. Now, that is a possibility, because I believe that is the psychological level that we need to see silver climb past as gold did. He said the sentiment will shift and the price is likely to explode to the upside. And I don't even necessarily know about that. It could just creep up more. The Velocity Shares 3X long silver ETM product could be an excellent tool when it comes to buying dips on the silver market. These electronic trading methods are ones that I tend to avoid, but I know some people that want to literally, quote, invest in silver. That is something to consider. And then it goes on to talk about, again, more of the types of moves, because this author here, Andrew Haidt, works in that world, and I typically don't. But this goes on to say that he is bullish on silver. He believes we will see more indictments, and the Department of Justice will attempt to create a case against J.P. Morgan. However, while individuals will face charges, the government will only extract fines from J.P. Morgan. When it comes to the prosecution record of the DOJ, juries have sided with defendants, and it will be interesting to see if that trend continues in the case of gold and silver manipulation. I continue to believe that the DOJ overstepped with the RICO charges, which will lead to acquittals. I do not condone illegal spoofing and manipulative behavior. Those responsible should face punishment. Meanwhile, when the government seeks a penalty, that does not fit the crime, we have seen the juries reject the cases. When will the DOJ learn? And that is interesting. Does it not fit the crime? Is the RICO statutes? Is there some racketeering going on? I don't know. I wouldn't be surprised, knowing the track record of the prosecutions of these. They could have been emboldened and done more serious things, realizing and expecting this sort of reaction. We'll find out. But I think that the key is here is that, yes, some of it will continue. My guess is right now it's not as much because they're under investigations. They would be very foolhardy to try to engage in this spoofing so brazenly that they have in the past. And look, silver's still down. And that ends to the summary that in the case that I've always made, that I believe natural market forces play a much larger role than this manipulative behavior of sorts. And keep in mind, this is the short, and with the short markets, not the long markets. So, but it does happen, with something to think about. But not only does it happen with gold and silver, it happens with other commodities as well. So I believe that J.P. Morgan is activities, even though they are the largest custodian holder of silver holdings, I don't believe that they play as big a role as others feel in this community. So there you have it. Post your thoughts below. I'd like to extend a multitude of gratitude to you all for watching and encourage you to please rate, share, comment, and subscribe.